I think the important message is that the covered bond market is still an attractive asset class that you can use in many different ways to compose portfolios for clients. If you have a yield of minus 0.1, it's still much better, for example, than a yield of minus 0.5. So it's always the alternative that I think is important to compare with. I mean, interest rates are so low and they will only go higher, but they have still not moved higher in the last 5 years, and maybe they will not move higher in the next 5 years either. So there still is this price appreciation possibility you have that you have from bonds.
I think the interesting part is really how the ECB will behave. Now they increase the monthly purchase volume by 20 billion, and we expect that the main focus will be on the public sector side, that they will buy more public sector as in govies and agencies, and we don't expect an increase on the car bond side.
The ECB is still the main driver in this space. They've been as nice to the market as they can be. And the message, I think, to the ECB in the room was also just keep doing what you've been doing and don't overdo it with an increased pace of QE buying from now on. I mean, they have a challenge of getting an extra 20 billion a month. They should just try to not get it from covered bond space, because the TLTRO that they've also announced already reduces issuance. If they increase the pace, they'll have to increase the secondary market purchases, substantially, and that would pretty much put the market in a dysfunctional state again. So buy the stuff in govies and agencies, but leave covers alone.
I think what they will do is they'll prolong this CBPP3 into 2017, and they'll end up with 300 billion plus of covered bonds on their books, and they will thus be a main driver of the market and the spreads. Hence, the oil price as a big driver of spreads.
Liquidity is a big topic. Basically, we're coming from a market where we had an artificial market making before the crisis. That has stopped, and since that, obviously, liquidity has decreased. Now we have the ECB as a very, very big buyer, investor, and buy and hold investor. We have other purposes like LCR, where people are also buy and hold investors, and this is definitely decreasing liquidity. And the question is, how do we improve and how do we make people comfortable which need this liquidity? But I think that the ECB is trying to be really sensible in terms of adjusting and to listen to the market participants in order to not dislocate the market too much.
I think the EU Commission and Commissioner Hill has been working on this, and I think there's quite a good, strong debate in Brussels recently. And the main focus there is, what kind of vehicle do we need to utilise going forward? And the debate around, should we have a covered bond law or should we have some form of covered bond directive? I think there's a consensus from that meeting that there are issues with the covered bond law in the sense that different jurisdictions have different legal frameworks, and the different jurisdictions have different real estate finance issues. So I think coming from that, the kind of consensus, certainly from the investment community and the feedback we got from the Commission, was that it's more likely to be some kind of very high quality covered bond directive, whereby you maintain the highest standards, abide by those, but not really going down the very rigorous legal route.